we are working towards several important measures of bank performance. One key measure is the return on equity. This tells us about the return on investment for the owners of the bank. In this session, we are going to back up just a little and discuss bank equity capital. First, we will precisely define bank equity. Then we will discuss how equity relates to profits as well as losses at a bank. To fund new projects or expand operations, just like any business, banks can use equity as a source of funding. Equity represents a share in the ownership of a bank. When a bank sells equity, it is selling part of itself to some outside investor. That outside investor will become a stockholder or a shareholder in the bank. Owning shares gives certain rights. First, in exchange for their investment, the new shareholder will be entitled to a slice of the bank's profits. If the bank does well, these profits will eventually arrive in the form of dividends. On the other hand, if the bank runs into financial problems and is sold or shut down, then shareholders will have a residual claim on the profits. Debt holders are always paid first. Shareholders get whatever is left over at the end. If things are really bad, they could get wiped out. Owning shares also gives voting rights. This enables shareholders to influence how the bank is managed. This aspect is important, but it's not central to the remainder of our discussion. To make things concrete, here is JP Morgan Chase in 2020. JP Morgan is a big bank with some $3.4 trillion of funding. Of this funding, about $280 billion comes from its equity capital. This consists of the paid-in capital from the issuance of common and preferred stock. Preferred stock is the same as common stock, but it usually receives dividend payments first. Here we can see the majority of JP Morgan's equity comes from retained earnings. These are profits that are not paid out, but instead reinvested into the business. These profits should eventually flow to the shareholders. Let's focus on the payout structure of equity. We will cover a very simple bank and see what happens when we close it down. This is also called liquidating the bank. I want to illustrate how equity works as a residual claim in normal times and in bad times. Okay, here is our simple bank. It has long-term investments that are funded by short-term debt. So that's $90 of deposits, $10 of equity, and this funds the $100 of investments. What do we mean by equity as a residual claim? Well, imagine we are the owners of the bank and we decide to shut it down today. We would sell off all the assets for $100. We would first pay off our debts, so we would return $90 to the depositors, and then we would keep whatever's left over. The owners get to keep the residual of $10. Because equity is a residual claim, it acts as a cushion that absorbs losses before other liability holders. Let's see how this works at our bank. Let's suppose that a recession arrives and that some of our borrowers are unable to keep up with their loan repayments. Some loans may default. Let's assume that this reduces the value of the loans from $20 to $15. How does this impact the funding side of the balance sheet? Well, if we close down our bank today, the liability holders would be okay. We could sell the assets off and return their investment. However, there would now only be $5 left for our shareholders. Assets minus liabilities equals $5. They are not wiped out, but they took the entire hit. This is why we say equity is the first loss piece of the capital structure. It protects the liabilities against potential losses. This is also why regulators spend a lot of time thinking about leverage ratios and capital requirements at financial institutions. Since most bank liabilities are government-insured deposits, regulators would like to see as much protection as possible. Okay, let's wrap up. Bank equity capital is an important source of funding for banks. It shows up on the funding side of the balance sheet alongside debt. shareholders have an ownership stake in the bank. This entitles them to voting rights and a claim on profits. Equity is the residual claim. When assets incur losses, equity always takes the first hit.